This week, energy traders shifted their attention from China's reopening prospects and focused on the US and Europe, as the collapse of SVB and Signature Bank alongside the recent turmoil from Credit Suisse default risk put the entire banking sector on red alert. WTI shed more than 13% of its price over a 3-day period, reflecting fears for contagion, and is currently found trading at $68 per barrel, near 15-month low levels. In this report, we aim to shed light on the catalyst driving WTI's price, assess future outlook, and conclude with a technical analysis. Turmoil in both the US and European banking sectors seem to be fueling bearish bets for crude, as energy traders downgrade their optimistic outlooks for a rebound in WTI prices and side with caution. It all started on Wednesday last week with the collapses of both the Silicon Valley Bank and Signature Bank, which sent shockwaves across the United States banking sector and boosted speculation for a contagion on the international financial system. The situation got out of hand quickly as 2008-like background scenarios flashed before investors' eyes. During the weekend, the FDIC, the Federal Reserve, and the Treasury Department of the US held a joint meeting to discuss how to address the problem in attempts to contain the situation from turning into a full-fledged panic meltdown. The agencies decided to anonymously step and bail out SVB uninsured depositors' money, promising access by Monday morning. The market's nerves appeared calm during Monday's session, with the banking institution share prices recovering, finding support from the positive news. The following day, however, the fire reignited, this time in Europe, and the main culprit with Credit Suisse. The Swiss bank has been making headlines for all the wrong reason, and its share price has been slowly but steadily shedding value week after week for the past year, to say the least, partly due to the internal structural problems and stagnating profitability. And as the CVB's failure sent shockwaves across the global banking sector, the pressure on the bank intensified. The bank's CEO Ulrich Körner attempted to calm the market's nerves during a Bloomberg interview on Tuesday and openly asked from investors to trust the process. He stated that the bank has been implementing its transformation plans and more time is needed for the appropriate results to surface. He added, following the SVB upheaval, the bank saw material inflows on Monday, which were apprehended as a positive sign according to the CEO, and the statement somewhat cushioned the intraday fall. What followed the next day, however, took everyone by surprise. At another Bloomberg interview, Credit Suisse, largest investor, the Saudi National Bank, when asked whether to provide any additional funding to its distressed counterparty, the answer was an explicit result no. The comments delivered a devastating blow to Credit Suisse stock, causing it to freefall into its all-time lows, and swap market probabilities for default jumped by 17% to 57%, kick-starting a confidence crisis for the entire European banking industry. The event put excess pressure on the Swiss National Bank to address the situation and force its hand to cost a 54 billion lifeline to Credit Suisse to avoid contagion, prevent mass panic from spreading across the entire banking industry, and minimize severe implication for financial stability worldwide. As a result, the prospects for a systemic overspill scenario kept energy bulls at bay, as the bears rode the negative momentum wave and dragged WTI prices to levels once seen before in December of 2021. Prolonged fears for a contagion, which may impede growth and accelerate the deterioration of economic conditions, could keep oil prices suppressed until the matter is contained. Thank you for watching.